From the City of London for our audience worldwide, Bloomberg Real Yield starts right now. We begin with the big issue, a trifecta of positive developments fueling risk appetite.
We have less uncertainty.
The Fed is going to keep on sitting on rates.
What we're going to see is more QE.
They will continue the asset purchases.
It's about keeping conditions accommodative.
People are accepting that central banks are going to keep rates at or around zero.
It is time to take a bit more risk also in the credit segment.
Credit quality is deteriorating.
As long as the Fed is at zero, money will come into the market.
But don't forget also, we're getting massive issuance.
You need a strong credit research to look at single names.
Fundamental credit analysis is going to be super important next year.
Go down the capital structure.
Credit markets can continue their outperformance.
A lot has to do with expectation.
It's frustrating to see credit spreads at these levels.
Spreads have already tightened quite a lot.
People have got to be very careful.
People have got to be very careful. Let's bring in Morgan Stanley's Vishy Tirupattur, who joins us now for more. And Vishy, you don't share that view. It's up in risk, it's down in quality. And through much of this year, whenever I've questioned you, I've been wrong, you've been right. So tell me more.
I think what I heard earlier is right. There is a trifecta, as you phrased it. We have an accommodative central banks across the globe. We have better than expected positive news on the virus front, and we have what seems like a somewhat self-sustaining recovery that's underway. And so you put all these things together, we think we are in for a situation where, for credit, staying down in quality, increasing cyclical exposure or the right trades, and we expect to see going down the capital structure, going down in the rating spectrum, being the best play here for credit.
Vishy, let's start with credit then, on the more liquid side. What you'd be doing in and around investment grade, maybe towards the bottom end in triple Bs, in high yield. What kinds of things are you thinking about, the kind of sectors you want exposure to right now?
Sure. In investment grade, we think triple Bs over single As. While we expect that the fallen angel volumes will slow down as we expect to see a rebound in earnings, and the highly levered companies that we have seen so far, that have issued a lot of debt, sitting on a lot of balance sheet, we expect them to focus on balance sheet repair. So we think that that means that we will see the defaults sort of peak in the first to second quarter of next year. The continued, foreign angel activity from investment grade to below investment grade to slow. So all of those things mean that cyclical sectors that are, especially those that are impacted by COVID, is what we would like most. We would be overweight cyclical sectors. We would be equal weight financials, underweight defensive sectors like utilities and staples.
Vishy, build on the more cyclical sectors for me. There is a difference between surviving and thriving. You can make the trade right now on survival and you'll get paid quite handsomely over the next couple of months. That's not a trade that's going to work maybe over a longer time frame. Now, do you have that in mind right now? When you think about bricks and mortar in retail, for instance, it's Black Friday, so let's go there. There's a situation where some of these companies may just survive, and that might be good enough if you are down in credit quality, going up there in risk and getting paid because people thought these companies would default and now maybe they won't. Thriving's a different matter. How do you think about those things, Vishy?
What we think really is a very substantial earnings growth in companies, especially in those companies that have taken the biggest hit. So our equity strategists expect to see 25 to 30% earnings growth and a double-digit total returns in the global equity markets through the end of 2021. So a lot of this will be in the cyclical companies. So there may be, some segments that may not perform. A lot of them that is already reflected in price. And where we think perhaps the underestimation is in the self-sustaining, recovery that we are seeing, and the better than expected positive news on the virus front, while at the same time, the overall policy outlook remains very supportive.
So, Vishy, that's the cyclical mix going out into 2021. Can you help me understand how you'd balance loans versus high yield at the moment, given the rates factor that might be something to think about more in the back half of 21?
Right. So on loan, overall we think there is a on the whole we favor loans over bonds for the full year. Keeping in mind we are now thinking one full year ahead as opposed to being near term. So over the full year we like loans over bonds, and we expect the risk of the rates. We should keep in mind what we are thinking about rates. We expect the front end of the rates curve to remain anchored to pretty much close to where we are now, but the back end, 10-year Treasury and the 30-year part of the curve to steepen. So our expectation is that we will see 10-year Treasury is going to 145 by end of the fourth quarter, and with that, we think the rates will begin to weigh on high yield performance in the back half of 2021. So you put those things in mind. Loans we expect to outperform, to do quite well. We prefer loans over bonds over time.
On this constructive view on the credit market, Vishy, do you have a view as to why this isn't playing out in Treasuries right now? Because if you're expecting 145 on 10s at some point through 21, I think we need a bit of an explanation why we're not getting any move whatsoever right now on a 10-year yield through much of this month, largely because many people think the Fed doesn't want yields to go higher. They don't want the curve to go steeper. What's your view on that, and why do you think that changes next year?
We think the change will occur as the data starts to assert itself. So when we see growth showing up, our economists, Ellen Zentner on the U.S. economic side, Chetan Iyer on the global economic side, expect to see U.S. GDP levels come to the pre-COVID levels by second quarter of 2021. So start seeing a better data coming in, and that will drive some amount of inflation. So a combination of that is effectively what I expect to see showing up in the bond market. I think that at this point there are clearly some uncertainties that the market has been dealing with, perhaps more focused on the near term than on the longer term. So we expect that to change as we continue to see better data, perhaps some more fiscal stimulus as well. So I think the market was disappointed by that there will not be as much of a stimulus. That's really driven this big recent move. Having a united government could have meant a much bigger stimulus. We are not seeing that, and we, clearly on January 5th, we will know whether we would have a united government or a divided government. But even under a divided government scenario, we expect that there would be some stimulus coming through. Overall, we think, as some of these uncertainties resolve, we expect that to be reflected in the bond market.
Vishy, just a final question from me. I always find it fascinating, in fact, quite amusing sometimes, where we get this explanation that the Treasury market is trading on X and another part of fixed income is trading on Y, as if there are two groups of people trading the asset class and they're hid away in different rooms and they don't talk to each other. I think we've got to get our hands around this single dynamic at the moment, looking out to 21. Before we get there, the data is set to get softer. You're acknowledging that. And I think many people are willing to de-emphasize those risks for here and now. But a question I asked today, and Vishy, I want to finish on this question with you. If we get a sub-50 PMI before year-end in the United States of America, or maybe even early in Q1, how comfortable will you be with your current setup if that's the data point that we might get in the next couple of months?
I feel pretty comfortable where we are. Even under that, we do expect some amount of a wobble in the data in a very near term. With the spike in the virus cases, fourth quarter should soften a bit. But if we actually go to, as you're describing, significantly more weaker than what we're anticipating, that we think will be a greater impetus for a more proactive stimulus to kick in, even under a divided government. So we think, where we are, and from a policy support perspective, from the recovery thus far perspective, we think we feel still pretty comfortable in our, more constructive outlook on risk assets across the board.
Vishy, you've been constructive, you've been optimistic, and through much of 2020, you've been right. Vishy Tirupattur of Morgan Stanley. Vishy, always enjoy your time, sir. I hope you had a fantastic Thanksgiving. Thank you. I want to turn now to the final spread, the week ahead. Coming up, we get another read on the US consumer on Cyber Monday. Fed Chair Jay Powell and Secretary Mnuchin testifying on Capitol Hill, plus Fed Presidents Daly, Evans, Brainerd and Williams speaking throughout the week. US auto sales coming on Wednesday, another round of jobless claims on Thursday, and finally on Friday, drum roll to the main event, the payrolls report just around the corner. That does it from me. We'll see you next Friday at 1 p.m. New York time, 6 p.m. in London for more Bloomberg Real Yield. This was Bloomberg Real Yield. This is Bloomberg TV.